Okay, folks, welcome to Option Strategies for Earnings Season. David Russell, it's great to be with everyone. I'm here with with Jesus Nava as well. It's great to be with everyone. Just start off some disclosures here. So today we're going to be talking about option strategies for earnings season. And we do, of course, come to this at a strange sort of earnings season with a lot of big macro sort of impacts coming. But, we are going to look at some overall patterns that, overall often appear over time. I want to just kind of show that. I do have some examples from farther in the past. So Jesus was going to share some links in the actual chat. And if you have any questions, please go ahead and ask in the chat. So today we're going to start off by going through a few basic themes. First of all, we want to talk about preparing for earnings. Like many things, preparation is half the battle. And of course, TradeStation gives some really amazing tools for preparing for earnings season. And the next thing is we're going to talk about vertical spreads, probably the most common strategy people use for earnings season. We're going to talk about credit spreads, covered calls, and then certain kinds of setups and opportunities even for sometimes after earnings, because sometimes after earnings, there are some things that can be done with credit spreads, and we're going to be getting to that. So first of all, I want to start off by mentioning that we are going to share here a zip file. Now, let me just tell you really quickly. If you go to tradestation.com right here, you'll actually notice on the main page of tradestation.com, we have a link to a blog article. And in that article today, we actually did some similar sort of information that is, kind of related to our webinar. It's about, big, earnings season for big tech stocks. And we actually also have a link to the zip file at the top that I added to the top of this blog. Now, if you actually go into the zip file, this is what you're going to see right here. You're going to see, first of all, options for earnings season. This is an easy language document. Now, if you have TradeStation open, this is going to bring in indicators and tools that will then work with the workspace, and some of the functionality that we have is on here. So first we have that. This is the slides of what we're actually talking about if you want to see that. And then this is the workspace. So first of all, I would double click on this. Now I have TradeStation running and you'll see this pop up. This is the workspace I'm going to share. You go to the next and you'll see that it has 3 indicators in it. These are 3 custom indicators I've created using easy language. And by the way, Jesus does some great webinars on easy language if you're interested in learning about that. But just so you know, you would import these by hitting finish, and then the workspace will have the indicators it needs. Now, if you've done some of my other webinars, you may have these indicators already, just so you realize. I already have them, so I'm not going to import them. After you have imported them into your TradeStation, you can go to the options, tactics, earnings, this here with the blue icon, and this is the actual workspace. And that's what we're going to be working with now going forward. So just so you realize, this includes the studies and this includes the workspace. The studies need to be loaded for the workspace to function correctly. Okay, so here's our workspace that we're working with. Now, I want to now start off with Scanner. Scanner is a tool that lets people discover stocks with heavy options volume. It allows you to find all kinds of things, but we're going to use this for options volume. Now, one of the things about options is that not all stocks or underliers are created equal. Some trade a lot of options, things like Tesla and Apple and Nvidia. These are extremely active. And then most stocks are relatively inactive in the options market. And that means they may not have good liquidity, which means when you try and place orders, there might not actually be the ability to get filled on orders or to be filled easily and to exit them especially. So I wanted to emphasize that. One of the key things we want to look for are things that trade a lot of options, and you can always be building that list with scanners. I want to mention that. So here are the actual steps we're going to go through, and I'm going to very quickly walk you through this to show you how it can actually be done. So the main thing we're going to start with, I'm going to jump back over now to my workspace. I actually created just a quick little workspace here with Scanner. Just so you know, if you go to apps and then you look for the flashlight, it might be over here for you. You can move these around. But I have my scanner right here. It's the flashlight. And this is what it looks like when it comes up. Now, I wanted to set this up just so it's nice and big. Normally, if you see it, the letters won't be this big, but I'm going to create a scan. Okay, now we're on slide number 5, just so you know. And I'm going to call it, earnings active underliers. And I'm going to put just a number 1 at the beginning so I can come back and find it. Now, it's going to run in the background. So the first thing I do is I gave it a name. The next thing I do is I select the symbol of stocks. I'm going to go to all stocks. Now, what this is going to do is this is going to find all the stocks that trade a lot of options, which then we can find when their earnings come up and find potential chart setups. By focusing on those stocks, these are stocks that may potentially give us, good liquidity for option strategies. So I selected for universe all stocks. Now I go to next. Okay. Now there's a few different things here that are going to be criteria that we add. The first thing we're going to do is I already have I'm going to remove these because I have mine set up as default. So the first thing we're going to do is we're going to go to select criteria. One second. My computer is suddenly, there we go. All right, here we go. We're going to go down. I'm sorry. We're going to go down. I'm going to remove that. My computer had a little brain freeze, but anyway, we're going to go down to indicator, and we're going to, this is the key one, and we're going to go to volume all options. Now, an indicator is something that is calculated, and they're much slower, but they have often the real value we're looking for. So first we're going to add this, and then we're going to do another little trick to ensure that we don't end up more or less slowing the computer down significantly and scanning for too much information. All right, here's the indicator. So we're going to go to volume all, and then we have an indicator. This is included called volume all options, and we're going to hit OK. Now we're going to set as the operator greater than. Now make sure it's set to volume average. This has two different outputs. One of them is just today's volume of call volume plus put volume for individual stocks. And then the other thing is the average. So we're going to go to volume all average, and that's going to look at over a certain time period. If we open it up, you can see it's going to look at the previous 20 sessions, which is more or less a good amount. Now, what I'm going to do here is you see I set the operator to greater than, and I'm going to now put in the number 25,000 without commas, 250,000. Okay, now this will find all stocks that have traded at least 25,000 options in the last month on average. I'm going to add one more thing here because this also can be kind of slow. I'm going to go to up here on volume, and I'm going to say volume average 10-day greater than 500. I'm going to set it to 1 million. 1, 2, 3. 1, 2, 3. And what this is going to do is this is going to find underliers that trade at least 1 million shares a day and 250,000 options. By adding the second criteria, what we do is we weed out a bunch of relatively obscure stocks, because if we do all those stocks, then what's going to happen is the indicator, volume all options, is going to have to calculate for each one, and that's going to slow the scan down. So now I'm going to hit run. All right, now that's going to run in the background. I'm going to go on to our next slide. You can see here, first of all, see it's going through 1,900 symbols. So it's going to do that. And now it's actually looking for each one of the average options volume. You can see here, it applied the server filter, which means it went from 11,000 symbols to 2,000 symbols because we applied 1 million shares on average volume. So now let's go to our next slide as that's running in the background. That is scanner. The next slide is using radar screen. TradeStation's radar screen tool can track a range of indicators on a provided list of stocks. So we're going to now go to the workspace I've created, and you're going to see that it has a series of indicators. So I'm just going to very quickly explain these. The one that we're actually looking at first is average options volume. Now that is similar to the one that we applied on scanner, but there's a personal one I created that has a few little nuances that makes it function more nicely in radar screen. It's also going to show us the market cap and the 1 month change. So what I'm going to do now is I'm going to go to data, add symbol list, NASDAQ 100, for example. This is going to bring in the entire NASDAQ 100. Now, the thing to remember about radar screen is you have to give it the list of stocks. There's a few pre-built up here. When you go under data, you can bring in the S&P, the NASDAQ, and the Dow Jones Industrial Average. Those are just provided by TradeStation, but it won't have, maybe other stocks that are outside of those indexes that are maybe very active. There was a time when Tesla was not in the S&P 500. There have been times when certain highly active stocks that trade a lot of options, they may not actually be in one of the indexes, and that's why we're running that scan, which we're going to get back to. So what this thing really does now, as we look at this, is it basically is doing, first, it is going to show us, you can see with my average options volume custom indicator, you can find the ones that really trade a lot of options. Now, this has a threshold set. So if it trades at least 10,000 options a day in the last month, it will highlight in this teal color. You can adjust that by clicking on it, and then you go to studies, edit, and there's something in here called threshold, and it's in the inputs. You go to inputs and you can see it has threshold there set to 10,000 contracts. I could set it to 25,000 so it matches the other one. So this is one of the indicators I provided. You can see that it will then change how many are highlighted. Okay. Now, as we go back over quickly to this slide, that's what I just explained there, average options volume. Now, I added the symbol list in this case of the NASDAQ 100, and then I showed you how to sort. Now, the other thing is what this does is this is the key tool that we really want to look at in this webinar and during earnings season. Next earnings date studies. It doesn't have the most graceful name, but it has a lot of functionality. So this is a big indicator here. And what this does is this is essentially an earnings calendar, and it allows you to sort. Now, the great thing about Radar Screen is it allows you to sort by all these different criteria. So you can see in this case, I can sort by days. And what do we see? These are the companies that report earnings tonight. For example, Lamb Research. I didn't even know this. Texas Instruments reports tonight. So for example, you can just see here, and then it also tells you if it's in the, before market or after market. Most technology stocks report after the market close. So you can just see that right there. All right. And the other thing is that, so the way I often use this is what I'll often do is I'll go up and I'll say, all right, I only want to see the things that trade a lot of options. So I'll say if it trades less than 25,000, we're going to we'll go to data, add label row, for example. And now what we can do is we can now sort these by day. And then you can just go down and find them to trade a lot. So that's one way you can do it. Now I'm going to go ahead now and remove this. I'm going to go back over to my scanner, and I'm going to actually show you the results we got. There we go. We just ran this now. Hopefully it worked. Sometimes when I'm going to go ahead and run it again. This one is running. I'm going to cancel it. I have some that are running automated, and in this case, it's slowing things down. Sometimes it will conflict a little. Especially, I've noticed that recently when they upgraded Windows, it has interfered when I do live streaming. Okay. Now, the next slide we're going to go on to is showing how to actually use this on the chart. So these are the main tools here. So essentially what we could see by looking at that list is we were able to see the big NASDAQ 100 stocks reporting earnings in the next few weeks. We're able to see the ones that trade a lot of options, and we're able to basically plan accordingly. So now basically, I'm going to show you here this is Radar Screen can function as an earnings calendar. I showed you there the next earnings date. You can sort them once populated, and they can be copied from Scanner, which is what we tried to do, and we're going to do it again. Now, let's take a look on the charts. We're now on slide number 8. And if you look here, here's some interesting things about the actual way that we can use this indicator, and it appears right here. So this, actually, you'll notice, Texas Instruments, right here, it says the earnings are coming up. Now, look at a stock like NVIDIA. NVIDIA doesn't report for over a month. You'll notice that the coloring is different on the actual little box up here. So this is this is like the sister indicator of next earnings date. And you'll notice that this one doesn't report until May. So basically it's not highlighted. But if I go to a stock that's reporting relatively soon, like Intel, for example, you'll see that it is highlighted in this color. So what this allows us to do is this allows us to be kind of highlighted and alerted to the fact that it's coming. Now, you can adjust this by going up here and going to edit text, and this little box will come up. And the basic ways you can adjust this, if you want to move it around, you can change the font size, but you can also, if you go to inputs, you can see, percent from right, percent from bottom. So for example, if I want to move it down, I could move percent from bottom to say 90. If I want to move it some to the right, I can go percent from right, say 60, and then we can move that around. You can also adjust the threshold of how many days before it highlights in that orange color. So you can see it move there. I also go back here, edit text, and bring this back up again. You can see there's a threshold. So you can say, I want to be alerted if it reports tomorrow, the actual change text color number of days. That is the actual threshold. It's set to 5. So you can see that right there. Now let's see if our scanner works. It's not working, and I'm going to take one more quick look at it, and then we'll just move on. If you work on this on your own, it's not very hard to make it work, but sometimes I'm telling you, it has really been an issue for me recently that Scanner often does not work. Yeah, this should be working, but Scanner often does not work when I have the live stream going. It's just happened to me sometimes during webinars recently. I'm going to go back here to data, and I'm going to go to add symbol list NASDAQ 100, and we're going to get into some of these actual strategies. Now, what I'll say is go to that. If you need instructions on this, remember, we do have the slides in the zip file that show you how to actually build that. So now this is building in. It's going to have most of the big tech stocks. We're going to go ahead and keep moving here. We've got about an hour and 45 minutes until the close. All right, so these are the instructions here in slide 8 of how to customize on the chart. All right, so now we're going to get into the fun stuff of options and understanding calls and puts. And I think we roughly know that calls are options that can profit from stock prices moving higher. They fix the purchase price. So if the stock rallies up and above the price, then the calls gain value based on that. They have what is called positive delta. Now, it's very important, in my opinion, to understand delta whenever you do anything with options, because delta tells you how much the option is going to track the underlying, and it's also very important for doing covered calls. So you can basically own a stock and then sell calls against it as a covered call, as we're going to get to. Puts are just the opposite. And basically what they do is they fix the sale price. It's like owning insurance on a house, and then if the house burns down, they make money, so to speak. So basically the idea of something like this is if it drops under a certain level, then the puts gain value. They can gain value in stocks decline. They have a negative delta, which means that if the stock moves up in value, they lose value. But if the stock moves down in value, they gain value. Because if a stock goes down, it's a negative number. The delta is negative. So that way, they basically gain value potentially to the upside. And they can be sold against other puts in a vertical spread. That is slide number 10. All right. So earnings and implied volatility. Implied volatility is an estimate of how much the market anticipates the stock may move on an annualized basis. So we actually have an included indicator we mentioned here as this shorthand, IMPL volatility, all options. And it can show on a chart, radar screen, and scanner. It often drops after major events like earnings. And this is a very important point if we actually look. The other indicator on this chart is the earnings postings. It's called EPS postings. And you can see here when the earnings came out. This is implied volatility, all options, this right here. Now, what you'll notice about it is you'll notice that after the earnings happens, the implied volatility drops. So this is a very important thing that we need to understand for earnings season, is basically that before the event, implied volatility increases. After the event, implied volatility usually drops, especially with earnings season. Now, the thing to remember is just because it drops doesn't mean that the price does anything. This is purely in the price of the overall options. So what it means is that the stock didn't move at all, a call or a put would lose a lot of value because the actual pricing includes the implied volatility. So that's the important thing to realize, and we're going to get to that next. Let me just go back to my slides. We keep moving here. So before we go on to this, let me just kind of go to my OptionStation Pro. Now I have this already launched and I set it up in white so we can kind of differentiate from the chart. But if you don't know how to launch it, you would go to apps and then you'll see it looks like a kind of like a paper airplane. It's up, in this case, I have it here. It might be somewhere else for you guys, but it's this workspace right here and it comes up. Now, another thing I want to mention is you'll notice I have this step with blue global symbol linking. So this actually means if I click on one of these stocks like Pepsi or something, it's going to pop up here in the chart, and it's also going to pop up in OptionStation Pro. The symbols are linked together. So I wanted to actually show that. Now, the idea of a vertical spread is, let's go to one that's going to be reporting soon. We're going to start off with Intel. Now, remember, if I want to use this workspace, I can go up here and I can go click right here on days. Now, Intel is in the NASDAQ 100. So you can see right here, I'm going to look down the list and there's Intel. So for example, we can see Intel reports tomorrow afternoon. So say, for example, a person thought that Intel was going to rally. They actually announced some job cuts today. This stock's been in like a range. And, people might say, you know what, if all the bad news priced in, or you might have a certain positive view, for example, on the name. And so, for example, a person could say, I think it's going to rally back up this range, maybe towards 26. It's purely for educational purposes, but a person might see that as a potential. I think it could move back up this range. So what a person can do now in OptionStation Pro, you'll notice that all these options have different expirations. So we have basically our calls are on the left and the puts are on the right. Now, if the earnings come out on the 24th, a person could position for that using the options expiring on this Friday, which is the 25th. So we open this up and we now see all these are calls on the left. Now the stock is at $20.80. So for example, a person could say, I think it's going to jump to say 23 or above 23. 23 is right about there on the chart. And you could say, you know what, it had a range up toward 26. Maybe it goes up toward, maybe from 23, maybe it goes up to kind of 24 or higher. So a potential way to position for that would be for a person to buy potentially the 22 calls. I'm going to say 22, let's say it goes up to 23. So a person could buy the 22 calls, and then what they do in the vertical spread is they sell the 23 calls, and this can all be done in a single trade with TradeStation. So a vertical spread, traders can buy and sell calls or puts together in vertical spreads. They can capture move between two prices, in this case between 22 and 23. So what happens is it can generate leverage and help manage risk, but it also limits potential profit. So these can be really useful during earnings season for positioning and for hedging positions you might have. So the thing is, if we think, say for example, that we think the stock could jump up toward 23 or higher. So for example, this is the way I would often look to do it. I would click on the ask. Now, in the world of options, like a lot of things, the ask is going to be essentially the price you pay if you're a buyer. And if you're a seller, you get the bid. So in this case, you can click on this and you'll notice that it actually pops up down here underneath in the order. So you can now see that this is now down here below and it says quantity 5. So it says, all right, let's buy 5. This is just purely for educational purposes. Buy 5 of the $22 calls. You can hold down the control button now and click on 23 on the bid. And what that's going to do now is that's going to create a second leg. So the way this strategy would potentially work is it would, you can see purchase, in this case, 5 calls, and it would sell at the 22 strike, and it would sell 5 calls at the 23 strike. And what that would do is it would mean that the person, say the stock jumps above 23 and say it ends the week at 24. In this case, this strategy would essentially buy at 22 and sell at 23, which would be $1 of potential, return that the person gets. But the thing now is that in order to place this trade, it only costs about, well, in this case, 22 cents is right now the difference between buying for 43 cents and selling for 21. So it's roughly a 22-cent cost. So in theory, that could more than triple a person's money because a dollar, is more than triple 22 cents. So this is a bullish call spread. Now, if the stock stays under 22, it just expires worthless. But the thing about something like this is it allows a person to profit from a move. It's limited. If the stock goes to like $30, you make the same amount of money as if it goes to $27. So the upside is limited by the strategy. What it does is it essentially creates a binary payout with leverage built into it using a vertical spread. So this is the common thing people look to do for earnings season. Now, another thing about this you're going to notice is that these options here have purely time value. They have essentially, they're out of the money, which means that right now, if the stock was, if the options would expire, if it was Friday afternoon and the stock is not above 22, those calls are worthless. So the thing is, what you're doing is you are paying money for something that might happen with time value, and that costs money. But the thing is that you're also selling calls based on something that might happen as well. So you're collecting money from time value, and you're also paying money for time value. So the thing you're doing is you're basically creating a situation where you're having to pay for time value, and then you're selling other options to pay for the time value. And it allows you to simply capture the move that may or may not happen. But it's important to realize that because the time value is what gives these options their value. And after the earnings report happens, say the stock jumps to say 22, what you'll see is that the options will gain value based on their delta, but the implied volatility and the time value will basically go away. And those options, say for example, it jumps to like 22 and a half, those calls would be worth essentially 50 cents, and all of the time value would disappear out of them. So this is a way to capture the actual move around the event and to basically use one time value in the future to pay for the time value that you're using. That's the benefit potentially of a vertical spread for something like a binary event like earnings. All right, that was slide number 11. I also want to mention that just for educational purposes, now I'm going to go ahead and actually create this as the current natural, so to speak. This is the actual price right now. If I was to just accept the bid and the ask that are there, I'm going to go ahead and say hit place order. And what this is going to do And this is going to buy, you can see it there, buy to open 5 of the calls at 22, and then to sell the 5 calls at the 23 strike. So basically, this is going to have a cost of $390. The reason why is because each one of these contracts is going to be 22 cents, but we're doing it 5 times. So I'm going to, wait a second. I'm sorry. It's the cost, that didn't sound right. The cost is 110 and the maximum profit is 390. So you can see there that that is the overall risk reward. 22 cents times 5 is $110 would be the estimated cost of this. So I'm going to go ahead and hit yes. So the outright cost is 110. And then we have the potential payout of 390. And that's essentially that kind of risk reward that I was explaining. Now let's go over to the manage tab. And these are going to show our different positions. So what we have here is we have basically, these are shares. Now these are all simulated positions, but I have 500 shares of Apple, I have 500 shares of Amazon, and I have 500 shares of Microsoft. You can also see that I have a vertical spread now on Intel. So what this essentially did is you can see that the expires in 2 days, and I'm long, so to speak, the 22 calls and short the 23s. And you can see right here how this position balances out. Now, the interesting thing about this is that these options, it combines the actual delta. And what this tells me is that right now, this position is similar to owning 63 shares of Intel. The delta will essentially tell you how it behaves relative to the shares. I'm going to get to that in a second. You'll notice for Amazon and Apple, because I own 500 shares, that they have 500 delta. Now, covered calls, that's where we're getting to that. So now let's take a look over the chart of Microsoft. So I have a hypothetical position on Microsoft. Now say I think, this stock I don't think is going to go up very much. First, actually, let me first explain this to you. What a covered call is you basically selling options against a position in the stock. You're selling calls against a position in the stock. So a person owning at least 100 shares can sell covered calls against a position. One contract represents 100 shares. So there's kind of 3 ways to structure covered calls. One is you're selling calls that are in the money, which has the least amount of risk, and then the least upside. You can sell them at the money, which collects the most premium relative to the actual stock itself. And then you can do out of the money, which has the most risk, but the most potential for upside. Now, the way to think about this is by simply looking at the delta. So right now we have Microsoft at, say, $380 roughly, $376. Now we're going to go to OptionStation Pro. And we're going to go to the Microsoft. So you can see here we have 500 shares of Microsoft. Let's go to options on this. And now what we can do is, now let's see also when they report earnings. I'm pretty sure they're next week. So they report next week on the 30th. So now what we could do is we're going to close the 25th and we're going to go to May 2nd, because that would encompass the earnings date. And so say, for example, like I said, if you're selling in the money options, you have the least risk overall and you have the least upside. So it's interesting now, if we, for example, think, I don't think Microsoft's going to go up very much. I'm afraid it's going to drop after earnings. One approach people might have is they can sell these calls that are more in the money. Now, if we look at these calls, I'm going to go up here and add actually a column. I'm going to add customize columns, and I'm going to add intrinsic value, and I'm going to add extrinsic value. And what this is going to do is you're going to actually see that if the stock's at 376, these have right now, well, the intrinsic value on these is around $6.57. You can see that. So you'll also notice that these have a delta of, say, 61. So if a person was to sell these in the money calls, for example, at the 370, which is $6.50 below the current strike, you'll notice that you're going to basically have 62 deltas. So a person now could go over here and click on the bid. And what that's going to do is that's going to basically simulate selling 5 calls. And by doing that, what would happen is, as long as the stock stays above 370, then basically on expiration, my calls get called away from me at 370. Now I'm going to collect upfront $14.55, but that's to be paid $6 lower at 370. So I'm really going to collect about $8 of options premium, and then I'm going to collect about $6 of intrinsic value, And in this case, this is the more conservative approach. And what this would essentially say is the stock could fall a few points and I'm still going to basically collect my money. So in this case, you can see that the limit price is around $14.70. I'm going to just go ahead and set this to market just so it executes. And I'm going to go ahead and place the order. Now, what happened by doing this is that I now have a position where instead of owning 500 shares, I basically, on each share, on each 100 lot, I essentially lost about 40 deltas because I sold 61 deltas. So by doing this, what you're actually going to see is you're going to see that my net delta on Microsoft went all the way down from 500, it went down to 194. Now I had 500 shares and now my net delta went down. The reason is because I have 500 deltas of stock, but I'm short 300 deltas. So essentially by doing this, what this means is if the stock falls a few dollars, then basically I won't lose any money because I already reduced my delta. So in this case, by selling options that are deeper in the money, I'm actually reducing my delta and reducing my directional exposure to the stock. So that's a way to think about it. So let's see if I can go ahead now. And the next one we're going to look at is going to be Amazon. Now, let's say with Amazon, we think it's not going to move. I'm sorry, Amazon, AMZN. I think it's going to kind of stay right where it is. I don't think it's going to drop a lot. Now, I'm just making these up just for illustrating. And you'll actually see here that in this case, I might look to actually sell options right at the money. In this case, the stock's at $182. We can go back to TradeStation Pro. Now they report also the same week next week. So I'm going to be looking at the same expiration, which is going to be May 2nd on Amazon. So the stock's at $1.82. So I could go right here and I could see these. Now you'll notice that these have how much intrinsic value do they have? They have no intrinsic value, and they have basically extrinsic value of $6.90, and they also have less delta. I sold before on Microsoft, I was selling more than 60 delta. This time I have 50 delta. So in this case, I can go over and I can actually click on bid. And what this will do is this will create a potential order to sell 5 of these options. And what you're going to see is, I'm going to go ahead and just do it as a market order. And now let's go back over and you can see how it behaves. All right, let's go now to manage. And you're going to see now with Amazon, you can see that I basically now have a position. I had 500 delta, which means that my position would behave like owning 500 shares because that's what I did. But in this case, you can now see that my position, I essentially cut my delta in half, which means that if the stock falls a little, I have some risk removed. But the thing about this is, say the stock just stays exactly where it is. What will happen in this position is the actual calls that I sold, because they have all extrinsic value and no intrinsic value. Say the stock is at $182 on expiration next Friday. These options will simply go worthless, and I will have collected $6.88, basically holding the stock for less than 2 weeks. This is collecting value, collecting premium, collecting a credit from the passage of time. And in this case, the thing to remember about it is that I thought, I think the stock's going to do nothing. So what I'm doing is I'm focusing on selling the options that have the most extrinsic value. You'll also notice that right at the money, you have the most extrinsic value. The deeper you go in the money, you have more intrinsic value because those, as you go in the money, the option will include the value. So for example, down at 170, if the stock's at 181, those inherently are going to have $12 of intrinsic value, simply because of the fact if you can buy the stock at 170 and it's worth 182, then those options have to have a value of $12. But in this case, basically they have no intrinsic value. They have pure time value. And if the stock stays at 182.5, you're going to collect the maximum premium by selling right at the money. So that goes back to essentially what we said here. If something's at the money, you get the most premium. And you're also kind of saying, I'm the most neutral on the stock. I purely want to isolate the option value, the options premium, and then I want to basically be neutral on the stock and collect premium. So this is a strategy for maximizing the premium. Remember, if you were to sell in the money calls, like the Microsoft calls, and the stock stays where it is, the stock will be sold away from you, and you'll basically end up in a position where you will no longer own the stock anymore, and it will be called away from you. Now, maybe you want that, but in that case, that's actually when the in the money strategy is the one that we showed. Now, the last one is out of the money. So let's now take a look at the other position I have down here. Is what do I have? I think I have Nvidia. Now, Nvidia reports farther out in time, but I'm going to go ahead and just wait. Where is this? I'm sorry, Apple was one. All right, we have Apple. Now, Apple's one we want to look at. We have right here Apple. Let's say I'm bullish on Apple. I think, I think Apple's gonna have a nice report. I think they're gonna jump up to say 225. Up here, you can see we essentially had this level back here from the end of March. You can say I think it's going to go to $225, for example. Now the earnings are also that same week. Now we go here to options. You can see $225. These calls all the way up here. Wow, those really are a low premium. But a person, for example, could basically, just to illustrate, I'm going to go lower. Let's say we think it's like 220. Now in this case, the stock is at $205. You could go potentially and click on the bid at 220. And what that will do is this will essentially, same thing, create an order to sell, in this case, 5 contracts for 500 shares, and it'll bring in $1.20. Now, if you look at this, you'll see these have absolutely no intrinsic value. They have a small amount of extrinsic value. They also have a very low delta. So I'm going to go ahead and set this to market. And what you're going to see is that my net delta is going to be much higher because I'm selling much less delta. So let's go now and look at manage. And you're going to see for Apple that my net delta is 418. So remember, I have 500 shares of all 3 of these on Apple, on Amazon, and on Microsoft. In Microsoft, I sold options that were about 6 to 7 points in the money. And as a result, I reduced my net delta significantly, which means that the stock falls a little bit, I won't lose any money. So what have I done? I've created a hedge that is somewhat bearish because it has reduced my directional exposure to the stock. And then with Amazon, what I did was I sold them right at the money, which reduces my directional exposure a little because I've sold some delta. But the main thing that's going to do is it's going to capture the time value and let me collect the premium from the stock essentially going nowhere because it's a neutral strategy. And then the most bullish strategy with Apple is I'm going to sell options that are way out of the money. I'm going to collect a little bit of premium. Say the stock jumps to 210 or something, or 215. I'm still going to collect that dollar or so, and I'm going to keep that, and it's just collected premium that becomes essentially profit. But the stock jumps up a little, I remain exposed to the stock, and I have the potential to profit the most from the upside. And each of these things I want to emphasize can be seen in the option Greeks under net delta. So this is why OptionStation Pro can be so powerful when we actually go to the manage tab and we can actually visualize. So it's always useful to be thinking about with options, especially when you're doing covered calls, what is the net delta of my position going to be? So I want to also mention, we shared the link for it, but we do actually have another article here. It's called Memory Trick for Options. And you might want to just check this out. We shared the link to it. We did it on the blog back about a year ago in May of 2024. But the idea is that delta, it's a little memory trick. The D is for direction. And then you can read that. It's a good little, memory trick for understanding some of these relationships and keeping them straight in your head. Now, let's get back to our slides. As I said, net delta can be a useful metric for covered call positions. Now, there's this other strategy, which is basically a put spread. Now, it's just the opposite as a vertical spread on calls. Essentially, what you're doing is you're doing a vertical spread on puts. So say I'm bearish on Apple, and I say, I think Apple's going under 200. And, we could go here and we could say, I am going to, for example, I'm going to buy the 200 puts. I'm going to click on ask. And then I'm going to say, I think it's going to go down to 195 or lower. Hold down control and hit 195. And you can see now, what is it going to do? It's going to create a position that is going to buy the 200 puts, sell the $5 puts. The cost is about $1.50. If it goes down to 195, the spread becomes worth $5. I paid $1.50 for it, which is $3.50, which is a little bit more than 200% potential profit. So anyway, that is a bearish put spread. And in this case, on something like Apple, it would go down for the stock going under 200 down to 195, just breaking back down. So I want to just kind of mention that overall. Now, If we actually look at these as hedges, there's kind of two ways to think about it. If a person does that, like, the Apple, it costs $1.50 to put on the spread. So that has a cost. But the thing is, say the stock jumps to 250 or something, all I do is I lose the cost and of the option and I profit from the stock. So the thing is, by putting on a put spread, you have the potential for unlimited upside. So say you own a stock, but you're afraid that maybe a bad thing could happen on earnings or a certain date when some bad thing might happen. By owning a put spread, you have to pay money for it, but you have unlimited upside. A best case scenario would be the stock, has a big rally, you lose your premium, but you make a ton of money on the options, on the shares. That is, the best case scenario. Or if a person is simply just bearish on a stock, you would simply profit from the stock dropping. Now, the thing about a covered call is there's no upfront cost. Like in Microsoft, if I own that stock and I sell those calls, then basically I'm not paying any money at all. I'm collecting money. So it has no upfront cost, and that can be kind of nice. However, if the stock jumps to 400, I get nothing. I'm basically locked in at the money I collected at the time, and it's game over in terms of any upside beyond that. So the best case scenario is that the stock has a limited move with covered calls. That's the way to kind of think about it. So one, you get paid up front, but then you don't have as much potential for things to happen. The other one, you have to pay up front. And if the bad thing or if the thing doesn't happen, then you basically your premium. All right. So these are some ways I like to kind of look at these actual setups I'm going to get to here. Basically, I've noticed that there's certain kind of patterns. And I'll say right now in this market environment, it's kind of tricky to be doing, potentially vertical spreads. There's a lot of things have been falling a lot, and we might be in a certain spot where things rally and they get sold because there is a lot of negative momentum. So I want to mention that out. So I want to look at some of these historical examples, because what I've noticed is when it has space for moving higher, the MACD is kind of flat or rising, and you have the rising 50-day moving average. These are certain setups that can really work to the upside. Like I said, in my kind of experience right now, at this exact moment, given all the sort of, volatility and the kind of bearish momentum in the market, we haven't seen a lot of these setups. But for example, on slide 14, you can see I actually list them. So if you look back at Broadcom, AVGO back in December, this was a classic example of this. So basically, you know what? I don't have the 50-day moving average on this chart. I'm going to add it very quickly. Go to studies, add study. But here's an example. This was the earnings report right there, that big rally. You can see MACD was just starting to get positive before the report. I'm going to go to moving average one line. It's going to let me customize it. I always do my moving average, my 50-day moving average in red. So I'm going to do it super quickly, set it to 50. We're going to go to style. We're going to make it a little bit thicker, go to color and make it red. All right. So you can see here that Broadcom at this time was right at the 50-day moving average. It was kind of inching higher. Now, in my view, these are the sort of things when vertical spreads can work nicely, when you basically have a long-term move and it's kind of just has that potential to explode. You can see it was in a gradual uptrend where basically the MACD was essentially just kind of flat, getting positive. It was essentially neutral, but it had the longer term uptrend and it hadn't really gone anywhere for like 6 months. These are the sort of things where it has that upward bias, but it has space to the upside. That's, I think, the key thing about this is that it wasn't extended. When something is very extended, then you might not actually get the move. So this is one example. Another one was JP Morgan back in January. In this case, you can see also that the stock had some upward sort of momentum underway. And then you can see this was the earnings report right here. For some reason, I lost the little EPS posting. But regardless, this was the earnings report. You can see it was near the 50-day moving average. MACD was inching higher. This is an example. Another one was Walmart back in August of last year. I've noticed that this stock was in a very significant uptrend for most of last year. And you can also look at Walmart where it was. This was an earnings report right here. And essentially, it was near the 50-day moving average, and it was in a longer-term uptrend. Now, I want to also mention that I've given you guys a little tool here that I don't want to overlook. MACD cross days since. This is a special indicator I created. This tells you when the MACD is rising. So we look here, for example, I mean, let's look at, Alphabet. You can actually see that MACD has been rising right here on Alphabet. So this is one of the things that, you can do with easy language. I isolated the MACD to be rising or falling, and you can sort on stocks that have rising or falling. So look at like Monster Beverage, for example. This one has a bearish MACD. So this, you can see MACD falling. So I want to just highlight, we have this included for you guys. There's some really amazing things you can do when you use easy language. So check out some of Jesus' webinars on that. But regardless, this allows you to also sort. And I want to just mention that because it's in radar screen, but it's a chart indicator. So these are some things that are potentially kind of bullish. Now, if I look right now, I mean, from my view, what I'm actually seeing is I'm seeing a lot of stocks right now that essentially have they're trying to kind of bottom in different ways. And so Intel was kind of interesting to me because what was interesting about Intel is the MACD is not turning higher. It's not trending, but it has a range and there's space up the range. And that's the reason why it was interesting to me. Now, another one that's jumping out to me a little bit right now, potentially, I wanted to just mention is IBM reports earnings this afternoon. And they also have been in an interesting sort of spot. This stock really has not dropped very much when you look at what's happening in the overall market. They've had a series of good earnings reports. You can see MACD is turning higher here. So a person I was actually thinking might want to look for, if you think there could be a good earnings report, looking for a move in the options, something like the 260, 265 vertical. Now these, we're going to go to the 25th of April expiration, and we can actually look here at something like the 260, and that call spread right now would go for a cost of around $1.11. Now, what a person can do is you can go and set a limit order. If you have more time to do this, you could go and just set the limit order for like 105, and then you can just let it go all day, and you may or may not get filled. But there are ways you can do things when you set limit orders, and if you have time and you can prepare for it, I'm going to just go ahead and set the limit. Let's set it to 105. See, I can use the arrows also to adjust that, and I'm going to just go ahead and place the order. And let's just see, maybe I'll get filled, maybe I won't. It's going to work in the background. But this is another way to think about it, is that when you use those limit orders, especially if you can anticipate things, you look for your setup, you find things that are near the 50-day moving average. You find stuff that have earnings coming up soon. You find things that have maybe a positive trend and momentum. You kind of look for some potential levels that could get hit. And then you basically can go in there and you can set the limit order, maybe several cents, maybe depending on the cost, maybe 25, 50 cents below where it is, and then just walk away and let it work all day. The stock moves around, the bid asks move, and before you know it, you might get filled. So that's another approach people might have. We don't have time to do all that in a webinar, but I did want to mention that. Now, let's just quickly also mention here, I just want to mention that I've also noticed this, it's just the opposite can also work to the downside. If you look, for example, at where, Micron was back in March, for example, it was just interesting to kind of see how it had this, the MACD was very kind of negative on it. And that was the earnings report. The earnings report was right there. So this was one that was on my list. It was near the falling 50-day moving average. Adobe was another one. So there are some of these also. We're on slide 15. But I've just noticed that overall, the things that can kind of work is when you have an established trend and direction, but it hasn't actually moved for 1 to 2 quarters. Then you can actually get that move when it will break through and has that space to kind of move. So for example, look at Adobe here. It had gone nowhere, basically. It had a history of bad earnings. And then basically a name like this had just kind of gap lower. So that's just an example. I'm going to keep moving here. Another thing I did want to mention is that sometimes what will happen is you can get a stock that drops on a good earnings report. Maybe it rallies a lot into the news. So now I'm on slide 16, and upward trending stocks that drop on earnings that are maybe like, in line or they miss a little bit. So look, for example, in Amazon back last August. There's a good example of this. Now, this is not relevant right now from what I can tell because there are not a lot of stocks that are in this position. But if you kind of look where Amazon was, last August, it essentially had been in this long uptrend and it got really hammered. But look at how RSI went oversold. So the key thing with that is, I don't have it on this chart, but the 50-day moving average was above the 200-day, for example. So it had a long-term uptrend. RSI got really oversold. And a person could, in that case, sell a put spread to generate income when you have that opportunity after the event. So I think it's just important to realize that sometimes you get a setup through the event when the stock will fall and it basically can hold. Meta had a very good opportunity like this as well last summer when basically they announced an aggressive AI. I think it was this one here. They announced that they were going to spend a lot of money on AI infrastructure. and you can see eventually a gap lower held, and then it essentially remained, and a person could have sold a put spread to generate income. So these are just some basic things I wanted to kind of show. I think it's useful to have these sort of strategies listed and sitting out there, to be looking at the environment, to be looking at things that are trending in one direction and may give that a potential for an explosive move off of earnings. Or if you get the other thing, which is maybe it doesn't have any setup before earnings, but very often you might actually see that the opportunity comes after earnings. That is another potential thing. Another thing that I would almost flip in this environment, and I didn't have time to get into this, but these things are explained, and Jesus and his folks do a lot of great work on this as well, which is call to sell credit spreads. A stock could rally a call credit spread. Maybe a stock could have a big explosive move this earnings season in the context of longer term weakness. And maybe, for example, just purely as a potential thing that might happen, a stock like Meta might have a big explosive move on earnings, and it might rally up to a resistance level, and that's where people might actually look after earnings to be selling a credit spread or something like that using calls. And those are some of the things that they explain also in some of their webinars. I don't have time to get to it now, but I did want to mention this because I think it's important just to kind of to recognize you have the potential for something to be in a trend to explode in a certain direction. You have the potential for something to get oversold or overbought after the event, but then you also have the incredible ability to use covered calls in a bullish, neutral, and bearish way. And as we highlight, and the key thing for all of that is looking at net delta. So those are the main things I wanted to look at. I think we might have just one or two questions. Is MACD different from the regular MACD? No, it is the same. I think those are my questions. I'll also remind everyone that tomorrow at 2 p.m., I do my market trends webinar. I do them every Thursday. I do webinars on Mondays and Thursdays if you want to check those out. Let's see. Jesus, did we overlook anything, or is that good?
I think it's good. I've been answering some of the questions here in the chat. Seems like I don't see any other pending questions, unless we want to give the audience a little bit of maybe a minute or two to see if there's any last minute questions. The MACD that you have on your workspace is the same MACD calculation, just displayed a little bit differently, right?
Correct. What I did was I took the MACD indicator here, and there's actually a value in it of days since cross. And what I did was I basically said, if it's a bullish condition, I'm going to make it a positive number. And if it's a bearish condition, I'm going to make it a negative number, because MACD doesn't have that. And then I isolated that. So I don't actually plot these other lines, the signal lines. All I plot is the days since cross, and then I give it a positive or negative value. And I did that as a custom indicator with easy language.
Yeah. And there's a question here about tomorrow's class. I submitted a link here to our events calendar, so make sure that you check that out for upcoming sessions. You're doing market trends tomorrow, right?
Yep.
Okay.
Market
cool.
trends at 2 o'clock tomorrow.
Yeah, and they're posted to YouTube too after you do them, right?
Those live stream to YouTube and Facebook and X, and you can also sign up if you want to do it as a webinar on the website.
Exactly. The replay takes a day or two. We have to edit the video. It goes to compliance for approval, and once everything is in place, it's posted on all those channels. So just give us a couple of days and it should be live.
Well, thank you all. I appreciate everyone for joining, and thank you, Jesus, for helping out.
Thank you, David. Have a great afternoon, everyone. Bye-bye.
Take care, guys.